SoFi stock has been on the move up 22% in just the last 5 days, catching the eyes of investors everywhere. So the question remains, is this just another short-term spike, or are we looking at a long-term winner? Let's find out. Just when the entire market turned red, SoFi was one of the only stocks to continue its momentum upwards. For the 7th straight day, SoFi stock is up and seeing its volumes explode. So what's behind this? For the first time in years, there is a consensus on interest rates, with a 90% chance of cuts in September on the FedWatch tool. Rate cuts make fintechs like SoFi more attractive because it lowers the risk of defaults and increases the value of existing loans. With less risk, SoFi can turn on the taps to aggressively grow their loan book, skyrocketing revenues. Speaking of which, SoFi's CEO Anthony Noto touched on this in his recent interview with CNBC. At a high level, Noto is confident in the direction of rate cuts, how SoFi's credit has performed, and their growth potential moving forward. Digging deeper, institutions have also been buying, adding fuel to the recent rally and suggesting that the smart money also sees the potential in SoFi. In fact, institutional ownership has consistently been increasing since August 2023, yet the stock is down 17% on the year. This suggests that retail has been selling and institutions have come in to scoop up their shares at low prices. Then recently, sentiment has flipped and technical indicators show bullish signals, with the stock breaking through key resistance levels indicating a potential for further momentum. Now, let's zoom out and look at the bigger picture. As a long-term investor, it's cool when your stock jumps 20% in a few days, but what really matters for you is what it will do over years. First up, the digital transformation of banking. With 2 to 3% cashback credit cards and growth of digital payments, there is less incentive to use physical cash by the day. If you can access your banking services with an app and store your money online, there is almost no need for brick-and-mortar branches. Online banking is only accelerating, and SoFi is perfectly positioned to capitalize as traditional banks are tied to the extensive costs of renting and maintaining some of our world's most expensive real estate. Without the overhead, SoFi can offer their customers significantly better rates on both deposits and loans, along with no fees. Think about it like this. Traditional banks are like old, clunky VHS tapes while SoFi is the sleek new streaming service. People are switching to digital because it's more convenient, cost-effective, and offers better features. For instance, SoFi offers superior rates on deposits with a 4.6% yield, compared to a meager 0.01% from the largest legacy banks. It's no wonder fintechs are gaining traction. Now, let's dive into why SoFi specifically could be a long-term winner. First, their growth metrics are off the charts. SoFi's member base has grown by over 700% in the last 4 years, reaching 8.1 million. Revenue has also been growing at a staggering 45% compounded annual growth rate over the past 5 years. And the best part, they're now profitable with management forecasting earnings to skyrocket by over 5x in just the next 2 years alone. That's by going from 8 to 9 cents of EPS in 2024 to a thumping 55 to 80 cents in 2026. The strong outlook is backed by management's execution of consistently delivering triple beats across the board and raising guidance. If SoFi achieves what management is guiding for in 2026, then the company is exceedingly undervalued and can offer you an attractive risk-reward profile. So why is the stock down 17% this year? It's primarily due to the high interest rate environment and corresponding concerns about SoFi's loan portfolio. In a recession or deteriorating economy, there's always the fear that borrowers might default on their loans. For SoFi, their loan portfolio makes up roughly 70% of their revenue, which is mostly in personal loans, along with some home loans and student loans. Still, SoFi mitigates this risk by primarily lending to high-net-worth individuals, with their average borrower having an income of $164,000 and FICO score of 746. The company is also resilient and able to move quickly. In 2021, the student loan moratorium completely devastated SoFi's biggest revenue stream at the time and should have crushed their business. Yet, the company navigated the roadblock outstandingly and transitioned to personal and home loans, growing as fast as ever. Reinforcing SoFi's resilience, let's talk about CEO Anthony Noto. This guy is all in on SoFi and a consistent winner everywhere he's been from Wall Street to the NFL. Noto has plenty of skin in the game and has consistently been buying shares, demonstrating he believes in the company long-term. Now onto their trajectory, Noto's next goal is to diversify SoFi's revenue streams further through rapid expansion of its technology and financial service offerings. And Noto said a few months ago that they are just getting started. As a small cap worth just over $8 billion, SoFi has plenty of room for expansion through both new members and new products to monetize existing members for years to come. All in all, SoFi seeks to become the one-stop shop for all your financial needs. In the long term, Noto has been vocal about the company's ambition to become a top 10 bank in the US. That's a bold goal, but given their trajectory, it may not be out of reach. Looking ahead, SoFi's next catalyst is its earnings coming right up in 11 to 12 days on July 30th. This report will be crucial as it will offer a deeper look into how well SoFi is managing its financials amid the evolving macro environment. Investors will be keenly watching key metrics such as revenue growth, earnings, default rates, and updated guidance. Positive results and guidance could reinforce confidence in SoFi's strategic direction, potentially driving the stock price higher. Conversely, any disappointments could lead to short-term volatility. Overall, as a long-term investor, I won't put too much weight into any given earnings, but I'm excited for management's commentary on performance and position going forward. So, should you buy SoFi stock now? This year's dip in SoFi's price can be an excellent buying opportunity if you believe in the future of digital banking and SoFi's place in it. The short-term trends are promising, the macro environment is shifting in its favor, and the long-term growth potential is enormous. And on that note, the company's fundamentals are not only strong, but growing rapidly. As with any investment, it's crucial to do your own research and consider your risk tolerance. Remember, never buy just because I am. Personally, I own SoFi and had it on my list of stocks to buy in July. Going forward, I'll continue to buy anytime the stock is under $8, and I'm looking to hold the company for years to come. So there you have it. If you've enjoyed, drop a like and subscribe to stay updated on my investing philosophy and insights. Your opinion is valuable. Drop your thoughts on SoFi in the comments below. Thanks for watching, and until next time, keep investing in your future.